What it really means to entrepreneurs, you have to understand the motivations of investors. And investors, not only would they like to get a return on their investment, and if they're investing in a number of early stage companies, if they invest in 10, they like to get a return on that total investment. But more than anything, they kind of want their money back. They want a return of that investment. So what are you doing to make sure that I'm going to get my money back and hopefully a little bit more? That's what's really important to investors and for entrepreneurs to understand that that is their motivation. Yes, they want you to build a good company. The only reason I'm participating in this, or one of the primary reasons I'm participating in this, is let's help you build a good company. You need my capital to do that. But no, I want that back at some point. And if I think there's too much risk and I'm not going to get that money back, I think the likelihood of getting it back is too low. I can't go forward with the investment. And for entrepreneurs to spend time thinking through that from an investor's perspective and ask the same questions that, if a competitor came to them and said, here's my business plan, here's what we're doing today, where are they going to spend time as an entrepreneur doing diligence on the competitor? They're going to take a look at not only those risks below the line, but what do they really have above the line that you think is worth investing in, and what's the likelihood that you're actually going to get that investment? And that's what drives M, and that's what drives the multiple. So now I think we're going to do questions, and I think Kim had some specific questions that she wanted to go through, and then I believe we're going to open up and other people can type in their questions as well.
Yes, thank you very much, Chris, for sharing Assay's methodology to valuation. I think it's very helpful to help break it down so both investors and entrepreneurs have a greater understanding of what are the nuances that help to drive or detract from franchise value. We are going to open up the floor for questions at this time. As a reminder, to ask a question, please type it into your conversation box, and Scott will take them in the order that they are received. Scott?
Thank you, Kim. We have this question from Sean. Can you apply your example to a specific company, such as a commercial plumbing installation company grossing, let's say, $5 million a year with about $750,000 in net profits?
Sure. So a commercial plumbing company. So some of the risks that I would look at in a business like that, obviously, there's a lot of legal risk associated with having employees. So if you're generating $5 million of revenue, I got to believe it's not just one guy out there turning wrenches. So it's looking at employment practices both from past employees, current employees, what kind of litigation might be able to come back and haunt an investor or an acquirer, and that could be anything from wage and hour issues, people not getting breaks, not getting paid overtime. So there's lots of things. All the legal liabilities. I think Kim, that was one of the ones that you had. But all the legal liabilities, it's all those potential things that could be lawsuits coming back. Was work done in someone's house? You can't be there all the time to look over someone's shoulder. Did employees potentially steal something from a customer? Was it just kids at home and they were harassing kids? There's lots of different legal issues that could potentially pop up. And also just looking at cost structure, looking at the revenue, how much is recurring revenue? Do you have concentrations? Do you do a lot of commercial work, but it's all for, maybe one or two builders? So if you have a customer concentration issue, again, you're going to get discounted because those are the types of things that worry acquirers or investors. And above the line, it's what do you have that's kind of so unique about the business? Plumbing is plumbing, but do you have systems in place for how you're dispatching your plumbers to make them as efficient as possible? Do you have some unique way that you're kind of running the organization, some technology that you've developed that allows you to buy product more efficiently or cost effectively? And if a plumbing company bought you and they could use that technology as well. So what is it that you have that's really unique? So it happens with any industry. It doesn't matter if it's a contracting industry, if it's a consumer product industry, manufacturing, service businesses, there's always something that companies have that are unique, that are proprietary, but it's about how do you own those? And again, one of the things I said about the strategic assets is they have to be transferable to somebody else. So if all this information, all these relationships with customers are reliant on one person or it's in one person's head, is that really transferable to somebody else? And that's how an acquirer or investor is going to look at that.
Great, thank you. And we have this from Richard. Difference in multiple in private versus public sectors.
There definitely are differences. So we will pull public sector comps. I cannot give you a quantitative number of what the discounts are because it does depend by industry. But certainly public companies, because they have such greater liquidity, anything in a privately held company essentially is an illiquid asset. So it's going to get a substantial discount to the multiple. And again, in private companies, we call it the multiple in privately held companies. In public companies, it's the PE ratio. So there certainly are discounts, but it is a very similar order of magnitude within public company comps. One of the examples I can give is when the oil rig blew up in the Gulf of Mexico a few years back, and we kind of saw where BP was priced. Well, they got priced down to really kind of the liability question, which was kind of what I was just talking about. So they got priced down to the liability layer because how much money is this actually going to cost the company to fix this problem? And they knew that there was going to be lots of lawsuits. So we saw stock price drop about in the range that we would have expected. It dropped further when one of the other layers in our framework is about the management team and specifically their ability to drive the business going forward. So when you have the CEO who's still out on his yacht while this whole thing is burning and spilling oil all over the Gulf, now you have another issue. So you saw another hit to the valuation, and the PE ratio just continued to decline. So the framework works on both sides, just the orders of magnitudes are so much larger in public companies.
Interesting. And we have this from Phyllis. So how do you value a pre-revenue, pre-profit in a growing dynamic market, innovative product, and license some IP out of university? Perhaps I'm not reading that well. Let me try that again. So how do you value a pre-revenue, pre-profit in a growing dynamic market, innovative product, and license some IP out of university?
I hate to be flip and say very carefully, but that's really kind of what you're going to end up doing. So no, honestly, looking at pre-revenue companies, it is looking at, if we're going to license this, what are the revenue streams? You're going to look at it more on a discounted cash flow basis. So over the next 5 to 10 years, what types of revenues do we think we're going to get out of this thing? What's the likelihood of getting that? What kind of return on invested capital we need? So we'd certainly build a discounted cash flow model for that. At the same time, we see it all the time, particularly at the angel investor level, and even some very early stage institutional levels, is a lot of those valuations end up being anywhere between kind of $1 and $3 million because you have the idea, yes, you have some IP, hasn't been commercialized yet, lots of risk associated with it. Let's figure out, let's call it 2 million, or often what we'll even suggest is if we can't really agree on the valuation because you're saying 2 million, I think it's worth 10 million, put that capital in as convertible debt and we'll actually set the valuation when the next round of capital comes in because by that time we will have actually gotten the product out into the marketplace, it will be generating revenue, and we'll have a good sense for what the kind of revenue and growth curves look like on the profitability curves, and then we can set the valuation at that point.
I think this is a good follow-up to that. This is from Carl. How often do you see the agreed-to valuation adjusted based on actual subsequent performance? That is, it's firmed up on once the risks and opportunities firm up.
Well, so it depends. On an early stage company, the valuations don't change. If you're getting your preferred shares up front, you're not going to really be able to renegotiate what the share allocations are unless that's built into some of the agreements. But what we do see on kind of more mature companies, so take the plumbing company, for example. So if that plumbing company is selling to a competitor, they're a little nervous about customer relationships, transferring over, employees staying with the business afterwards. And let's just call the company worth, $10 million. So if it's worth $10 million, someone might give you $4 or $5 million of that up front, but the other $5 million is going to be earned over a period of time just to make sure I keep employees, to make sure that I keep the customers, to make sure that, all these systems and processes and things that you developed get transferred to me in a way that I can actually use them. And if so, then you get your other $5 million. So that's one of the ways that you can bridge potential valuation gaps, or at least from an investor acquirer's perspective, make sure that you're not putting all the money up front just to see that the results not be achieved.
Thank you. And we have this from Richard. Minimum amount of skin in the game for entrepreneurs.
Can you clarify that, Richard? I'm not quite sure what he means by that.
And while we wait for that coming in from Richard, let's do this one from Brad. Could you speak to earnouts and other creative ways to bridge differences in historical future value perceptions between the seller and the buyer?
Yeah, so I mean, there's lots of ways to kind of create earnouts, and it depends on the type of sale that's being done, and is it just selling all of the company? I'll use that example first. So if you're selling all of the business, we actually just did one of our equity plans and delivered it this week. This particular company in this industry, they actually sell for a multiple of EBITDA, and those ranges, a multiple of revenue, and the ranges were anywhere from, I think it was about 0.5 times revenue. So if you have a $10 million revenue company, they'd sell for $5 million, up to about 4 times multiple. So they could sell for up to $40 million. If the sellers wanted to leave and thought the company was worth $20 million, because of the type of business it was, and it's a professional services business, it's all about the future income streams. So in that case, the only way I know that I'm going to keep those future income streams, and maybe I can pay you that 4 times multiple or 3 times multiple, but you're going to get only so much cash up front, and the rest is going to be performance-based. I typically like to do it on gross revenue on net revenue, because revenue is something that's fairly easy to manage. I don't like doing it on EBITDA because I can make EBITDA 0 anytime I want. I can do bonuses. I can buy lots of equipment and expense it. I can do all kinds of things to manage EBITDA. So I only like earnouts on either net revenue or gross margins. Gross margins are a good one as well, depending on which side of the table you're on. If you're on the sell side, you don't like gross margins because people could decide, I'm just going to keep selling for lower prices just to grab market share, and it's taking money out of your pocket. So that's one way to do it is through earnouts. There can be other kind of contingent payments. I mean, especially for the risks, we often see this, and this is something that attorneys love in particular, is there's all this potential litigation that may come back to haunt us afterwards. So we'll pay $10 million for this company, but $4 million is going to sit in an escrow. And the only way they get that $4 million after a year and a half, 2 years time, is if we haven't gotten sued on any of these different things. But if we do get sued, we're going to pay the claims just to make the problems go away, and it will essentially discount the total purchase price. And other ways to do it also, and something we're talking about for a current engagement that we have, is essentially we think the owners of the company are selling the business too soon. They're a little bit burned out on running the day-to-day operations of the business and carrying all the risk associated with that. So they want to sell the business. They're going to get some money up front today, but what they really want is they know that they're selling too early. So how can we share in the upside? And particularly this acquirer, they are kind of the front-end solution for the strategic acquirer. So they could bring more business into the core business of the acquirer, and it's how do they get not only part of the upside of what they're generating for their portion of the business, but also for the business as a whole. So there's lots of ways to say, recognize where you're adding value, because you're bringing a new strategic asset, putting another arrow in their quiver that allows them to cross-sell and upsell people in a way that they're not able to do today, and they should pay for some of that in some way. And if you can't get agreement on that upfront with a higher multiple, then structure an earnout that you get some type of royalty revenue and other things.
Great. And we have this clarification from Richard. He was asking about the minimum capital investment by an entrepreneur to interest outside investors.
That just varies so widely. So, I mean, what they want to see is that you've got some skin in the game. So whether it's, you've put, 2 years of time and, $75,000 of capital just from legal expenses and, covering, other kind of development costs and things like that. I mean, have you put some money into this thing? And we understand that maybe you don't have a big piggy bank to go to fund this thing yourself, but have you put something in? Have you at least gone to some friends and family? Like, are there some people at least who believe in you? And whether that's you've got 10,000 here and 25,000 from somewhere else, that has anyone believed that this actually has some legs that's giving you some money, and have you put some of your own capital in? If it's I haven't put a penny in, I have this idea, I've got this beautiful business plan, but haven't sold anything yet. haven't actually paid any capital other than what it cost me to print these business plans that I'm sending out to investors, and you have no friends or family have put money in, that's going to be a really tough one, because it shows a lack of commitment, and if you can't get someone to at least pony up a little bit of cash, and if you don't have something to put in yourself, it makes it very tough to get the confidence that there's a high degree of likelihood on the execution.
Great, thank you. And this is going to have to be our last question. This is from Christian. How can I, as an investor, find industry benchmark multipliers?
You can hire me. Actually, so talk to other investors, quite honestly. I mean, there are databases out there that you can pay for access to. Merger Market is one of them. BV Resources has a couple different databases of transactions for privately held companies, and again, they're all in different industries. So those are a couple of them that we use. We pay for the data, and it's constantly being updated. And again, just using some comps in the public markets, and knowing that you can apply some discount factor just because of, it's called a discount for lack of marketability and for minority interest, and that's usually be discounted, maybe 40 to 50, 60% or so. So the multiples would definitely be lower in privately held markets than public.
Great, Chris, thanks so much. I'm going to hand it back to Kim now.
Thank you so much, and thank you all for your very interesting questions. I think it helped to really build a robust dialogue, and hopefully you were able to get the information or the answers to the questions that you had. If not, please feel free to contact Chris Anderson at assayadvisory.com. His information will be on the last slide of this presentation. In closing, briefly, if you're like me, when I take the time to participate in a webinar or seminar like this, my goal is to walk away with at least one executable idea, that will help improve my company's financial position, or today, its valuation. So we hope that you will leave here with at least one aha moment or executable idea to make your time with us meaningful. I'd like to thank again Chris Anderson for helping us better understand what is in those numbers and what steps we can take today to improve our company valuation tomorrow. And for those investors on the call, a better understanding of what exactly you're paying for. And to that end, I'd like to let you know that for all of the companies that are raising capital through the breakaway funding platform, we embed in the due diligence documentation a financial sensitivity analysis tool, which basically means that you will be able to take the financial projections and change up to 8 different variables, whether it's margin, expenses, these things that can either be attractors or detractors to M in a company's valuation, to determine how far off a company can be in its projections and still deliver results that encourage you to make that investment. We will be sending you a post-webinar link so you may review Chris's presentation at your leisure. We will also be sending you a brief survey, not only to provide feedback on this event, but to solicit your input as to what other subjects and topics you would like to gain a better understanding. We invite you to register on our site at breakawayfunding.com to learn more about local private equity investment opportunities that await your investment capital, and or to learn more about how to raise growth capital for your company. Thank you again for joining us this morning. We hope you have found today's session valuable, and we look forward to seeing you again next month.